Let's talk about gold. One day the price is up, the next day it's down. Every single headline seems to be screaming a different story, and it can all just feel like, well, chaos. So today we're going to cut through that. We're going to find the real signal that's hiding in all that noise. You know exactly what I'm talking about, right? You see it all the time, the daily price swings, the dramatic predictions. It's confusing, and honestly, it's kind of designed to be. This is that short-term noise that makes trying to understand gold's real value so incredibly challenging. That really is the million-dollar question, isn't it? Or maybe the troy-ounce question. Anyway, if all that day-to-day stuff is just noise, how in the world do we find a pattern, a signal that's actually useful? Well, the answer is actually pretty simple. We have to zoom out. I mean, way out. By looking at over a century of data, we can start to tame all that fear you get from the headlines and put today's prices into their proper context. You're about to see that the long view tells a very different and much, much clearer story. Now, you might be tempted to just find one number to sum it all up. A single, simple average price for gold across its entire history. It seems logical, right? But as we're about to see, it's a bit of a trap. So let's try it. If you take every single month-end price for gold, going all the way back to 1915, and average them all out, you get about $393 an ounce. So is this it? Is this the fair value we've been looking for? Yeah, not so fast. There's the catch. That number is basically a statistical mirage because, as the source material puts it so well, it blends $20 era months with $2,000 era months. It just mashes together completely different economic worlds into one misleading figure. So, nope, this is not the signal we're looking for. And just so we're all on the same page, this is what we're talking about, an arithmetic mean. It's just a simple mechanical average. You add everything up, divide by the number of things you added. And look, it can be useful for some things, but for a history as dramatic as gold's, it actually hides more than it reveals. So let's just toss that one number idea out. We need a better approach. Instead of one single average for the entire century, let's look at the average price of gold decade by decade. Now, this lens is going to give us a far more insightful picture. We're looking at more than a century here, starting from 1915 and going all the way through today. Think of this as a kind of map of the different eras we're about to explore. Some were pretty stable, and others, well, they were just explosive. And wow, here is the story those decades tell. Just look at how sleepy the price was for half a century. We're talking $21 in the 20s. It barely moved to $36 in the 60s. And then, bam, the 1970s happen, and everything changes. The numbers just explode, and they tell a story of inflation, global crises, and a total reshaping of the market. This chart just drives the point home. The shift we're seeing isn't just a small change. It's a completely different market. The price in the 2020s is on a whole other level, a different planet, compared to the mid-century. Okay, so now we've seen the big picture. Let's zoom back in a little bit and look for a more subtle kind of pattern. Is there a seasonality to gold? Does it tend to behave differently in certain months of the year? Now, before we look at the numbers, this is absolutely critical to understand. We have to be clear on what we mean by seasonality. This is not a crystal ball. We are talking about a historical tilt. It's an average of how, say, all the Januaries have performed over many, many years. It's a tendency, a pattern. It is not a guarantee for any single year. So here's the data for the modern era. So everything after 1972. This shows the average return for each month. And you can see right away, not all months are created equal. Some, like March and November, have historically been pretty flat, but others, they show a much stronger tilt. And the standout is pretty clear. It's January. On average, since 1972, January has shown the strongest positive performance, with an average return of plus 2.8%. It's the most significant calendar quirk we can find in the long-term data. So, after all that, what have we learned? We've basically built a whole new context, a new framework for thinking about gold.
So the next time you see one of those frantic headlines, just remember these three things. Number one, that single, simple, all-time average price? It's a trap. Ignore it. 2, think in decades. That's where you'll find the real story. And 3, remember there are subtle patterns, like January's historical tilt.
And that is really the key takeaway here. When you're armed with this long-term perspective, you suddenly have a powerful tool to filter out all that daily noise. So the question I'll leave you with is this: how does seeing this bigger picture change the way you'll look at the price of gold tomorrow?